Hi everybody, I'm very excited today because I have a guest speaker who is Johan Deprez, tax attorney, local here in Southern California, and he's going to answer a lot of frequently asked questions about capital gains tax and special circumstances such as when one of the parties that owns the property passes away, what happens? Is there a special situation? So without further delay, let me introduce Mr. Johan Deprez.
Hello Nancy, how are you?
Great. So I'm going to jump right in and ask the questions that many of homeowners ask. And that is, first of all, what is capital gains tax?
Well, capital gains tax is really income tax, but it's income tax on the gains associated with selling property in general, but in our context, we're talking about real estate. It applies to homes, second homes, vacation homes, investment properties, whatever kind of real estate you're talking about. Part of the beginning exercise of trying to understand your situation is to figure out what's the capital gain associated with it, and then how would it be taxed.
Great. So capital gains is a form of income tax that's specific to selling an asset.
Correct. And so the basic calculation in real estate is essentially what you sell it for, less selling expenses, escrow fees, real estate agent commissions, those types of things. That gets you what's called the amount realized. And from that you subtract adjusted basis, which typically is the amount that the property was purchased for plus improvements. So if you add another room, if you redo the roof, if you redo the bathroom or the kitchen, the costs associated with that are added to your purchase price, and you deduct that from the amount realized. That's the basic calculation. Now there's, of course, like all these things we talk about, lots of little other details that, you call a tax attorney to discuss, right? But that's the basic calculation.
Great. So it sounds like you take the amount realized, like your net selling price, and then you subtract it from the adjusted basis.
Subtract the adjusted basis from the amount realized. Now be
Right.
careful that amount realized, again, the calculation is what you sell it for. So you sell something for $1 million, you pay, $50,000 of commissions and selling costs. That's amount realized is $950,000. What confuses people is that formula does not include any mortgage. So this calculation has nothing to do per se with the amount of cash you walk away from. So the net sheet that real estate agents provide includes the mortgage. That is not part of that calculation. So you can have lots of capital gain and very little cash, or you can have very little capital gain and lots of cash. And you run across both, but nothing to do with the mortgage. So that's one confusion people have often, and one of the things we try to set people straight on.
That makes a lot of sense. Nothing to do with the amount that you borrowed. Doesn't matter if you own it, free and clear, or if you bought it all cash or got a mortgage. That has no factor in the gain.
That's right.
Yeah, makes sense. It's kind of like if you bought an Apple stock at 100 and you sold it at 200. Your gain is what you sold it for minus what you bought it for.
Yeah, basically. That's
Basically.
Right. Yeah, exactly.
Great. So a lot of times my clients will ask this question: what happens when mom and dad or aunt and uncle had a house for 50 years and one of them passes away? What happens in that situation with the capital gains calculation?
Okay, so let me back up also a little bit and say the following. When we're talking about tax, especially in that context, we're really talking about three major tax categories that people need to be aware of. One's the income tax, the capital gains tax that we're talking about. But also there is estate and gift tax, which is another type of tax, and it doesn't apply to a lot of people because as of right now, the exclusion from estate and gift tax is $15 million per person. So for a couple, you have an exclusion of $30 million plus, inflationary adjustments. So for a lot of people, it doesn't matter. One of the key contexts in which it matters is if there is foreign ownership of U.S. real estate, or if people have ownership of foreign property. That's when it becomes more problematic. Like the basic exclusion is $60,000. Tax treaties may modify that. So, when you have that, it gets more complicated. For most people, for a lot of people, it doesn't matter if they have an estate of less than $30 million.
When you say it doesn't matter, you mean there's no estate tax?
There is no estate tax that will be applied. The exclusion, for a couple would be $30 million plus.
Great.
Okay. The other category of tax is property tax. And again, people get that confused with income tax often. So, and again, as property transfers, that is an important thing to also consider and not, again, get that confused with income tax issues or capital gains tax issues, and we see that confusion a lot. Okay, one of the key problems we see in intergenerational transfer is a lot of people mess something up by basically transferring the property from themselves and put title in their children. That 97.5% of the time is a bad move because the inheritance tax doesn't apply. And there may be other things that we'll talk about in a second that you're, wrecking for yourself by doing that. So, don't put it in your kids' names.
Okay.
Talk to there's lots of ways to accomplish whatever transfer goals that you have by trust and other means. You can get it done.
Share with us specifically what you mean by that's a bad idea, because a lot of people feel that's a good idea. So why is it a bad idea?
Okay. First, for most people, there is no, quote, inheritance tax to avoid.
Right.
If title transfers, then you're creating a reassessment event for property tax, which in certain situations is going to be a problem. And maybe a significant increase in property tax if you do that. But most importantly, what happens in the inheritance context is what is usually referred to as a step up in basis. When property is transferred upon death, that basis, that adjusted basis I talked about, what you bought it for plus the improvements, that gets substituted by a different type of basis. And that basis is basically the market value of the property at the time of death. Okay. So for example, if my nephew inherited a property that I owned myself, and the property is valued $1 million, I bought it for $100,000. This gain of $900,000. If I sell it the day before I die, I'm paying, whatever. The capital gain is $900,000. If he inherits, the basis for him becomes now $1 million, the market value at the time of my death. So if he then sells, sometime after, it's whatever he sells it for, or whatever amount he realizes, minus the $1 million step up in basis. So it can be, and often in California, it can be a huge difference. What, in terms of the basis that you're using to calculate when you inherit property.
Absolutely. So what I hear you saying is that there's something called step up in basis. So when a property owner passes away, their basis steps up from the price they paid, plus their improvements, steps all the way up to the date of death value.
Correct.
And then if it appreciates after that, the person who inherits the property just has to pay capital gains tax on that difference.
Yeah. Or the capital gains and the calculation, if they
Right.
pay or what they pay.
So that's
is
huge.
It's huge.
Huge.
It's huge.
And do I hear you also saying that if you transfer it, if you add on your heirs onto title, that you don't get that step up in basis?
Correct. Because when you transfer a property, say if I had gifted that property to my nephew because, I don't care to have it, but I want him to have it for sure. If I transfer it to him as a gift, then his basis is going to be the same as my basis. It's called a carryover basis. So if I give it to him the day before I die, his basis is 100,000. If we wait until he inherits it, then his basis is that stepped up to $1 million. So again, a huge difference, and that's the key problem of putting title into your children or whoever else, because they're going to get this transfer basis. They're going to have the same basis you had. They don't get the benefit of that step up.
Interesting. So let's say you have a couple, then they have 3 kids and they have 3 homes, and they'd like to gift each of those kids one of their properties. Are you saying that they should not put it in the kids' names?
Probably not. I mean, there may be circumstances where it makes sense. But usually, I mean, if you gift it before death, you're going to lose that step up in basis, and then the gain that those kids face is going to be much more significant than if they inherit it at some point.
Makes a lot of sense. Okay, so we need to be very careful about that. Putting kids or other heirs on title. Don't do it without consulting a tax professional, a tax attorney, or an estate planning attorney to really understand what you're doing.
Right. And make sure if it's an estate planning attorney that they are well versed in tax. They may be extremely well versed in how to draft trusts and different kinds of trusts, but they may not be well versed in tax aspects.
Okay.
It's hard to find both skill sets in the same body.
Right.
There are some people out there that have it. But
Or
a lot of
at
people
least
don't.
make sure they have a team behind them
Exactly.
and somebody they can consult with for tax reasons.
Exactly. I get
Excellent.
called on these types of things by trust and estate attorneys regularly.
Let me ask the next question that a lot of people ask me, and that is, this step up in basis for a couple, does that happen with the death of the second spouse?
It's a little complicated.
Okay.
Assume a simple situation where it's title, where the couple are both on title. If one spouse dies, there will be a step up and the other spouse inherits, then there will be a step up with the death of the first spouse. One of the big things that may make it slightly complicated is it depends on whether the property is held as joint tenancy, which a lot of people own their homes and certain other property, or whether it's held as community property. If it's community property, then you get 100% step up. So the whole basis goes from the 100,000 to $1 million in the example.
With the death of the first spouse.
With the death of the first spouse, if it's held as community property. If it is held as joint tenancy, only the half held by the deceased spouse that transfers to the surviving spouse, only that half gets a step up. The other half remains at that initial step up calculation, and actually 50% of that. Okay? So how you hold title is important in terms of how much step up you get as a couple when property transfers.
Since you brought up how you held title, what about tenants in common? How does that step up in basis work?
It all depends on the percentage held by the tenant in common. So
Okay.
whatever that is that you inherit, that's what gets stepped up.
Okay, just the percentage, because tenants in common is a different way of holding title where it's each separate. So it's like, let's say you have a brother and a sister who co-own a property. One could own 40% and one could own 60%. So if one of them passes away, that part steps up.
Yeah.
Okay, got it.
And the step up stuff applies to all assets,
Oh, even stocks and bonds?
even stocks and bonds,
Really?
but it's actually adjustment to market value, so you can actually have a step down.
Okay,
So,
right,
you know,
because
it
stocks
just-
go up and
Step
down.
up is just what is generically used as the term in real estate, because especially here in California, generally you're increasing the value
Right.
over time. But for other things, it doesn't have to be, especially financial assets. So
Right.
it can be actually a step down, so it may